Good afternoon. It's Friday afternoon, the 21st of August. This is Jeffrey Christian from CPM Group. Got a little bit of an interesting presentation today related to gold's purchasing power. Those of you who know CPM Group know that we have written extensively and studied extensively the value and benefits of having gold as part of your wealth and as part of your investment portfolio for decades. We're big proponents of gold, probably more positive about gold than some of the gold promotion organizations, in that our analysis and our work makes a very compelling story for gold. But that said, there are a lot of myths about gold that are misperceptions about gold that are common among investors and other people. One is that gold's purchasing power is constant, that there's a golden constant, that gold can buy the same amount of goods and services over time. It's just not particularly true. There are other myths, that gold is closely related to the dollar or inflation. But today I wanted to talk a little bit about gold's purchasing power, which is neither stable nor constant over time. And I'll show you that. But, I wanted to make the proviso first that this does not mean that we don't think that gold has tremendous benefits to investors in holding part of their wealth in gold and part of their portfolios. These two charts look at real or inflation adjusted gold prices over time. The chart on the right is the price of gold in real and nominal terms from 1700 forward. And that's from Roy Jastrom's book, The Golden Constant. He collected data from 1700 in England and from 1800 in the United States. The United States didn't have a currency until 1782 or so. So you can't go back to 1700 in the US. And what you can see here is that the nominal gold price was fixed by government fiat for most of that time, up until about 1968, when Lyndon Baines Johnson closed the private sector gold window and floated gold price. You had free gold prices in Switzerland before that, and you had free gold prices emerging in parts of Europe before 1968 as well. But it was really 1968 when the first gold window closed. And what you saw was that over that period of time, the price of gold fell consistently in its purchasing power. Its nominal price was ostensibly the same, but the amount of goods and services that a given amount of gold would buy declined. And if you look at it in 2019 terms, which is what we've done here, you can see that the gold price would have been about $5,000 an ounce in 1700. And it fell consistently. It fell consistently for a few reasons, including the fact that gold as a currency and quasi-currency earns interest, which is a thing I'll talk about in a second. But it also fell for other reasons too. And in 1776, when Adam Smith wrote The Wealth of Nations, he actually talked about how the gold price had already fallen sharply from 1700 to 1776, and was going to fall even further because he predicted there would be massive gold discoveries in the parts of the world that were opening up: Africa, Canada, the United States, Latin America, and Australia. And he predicted that the price of gold would continue to fall for two reasons. One was the discoveries of gold and the increase in mining that would come after that. And the other thing was the interest rate function. So that chart on the right shows you that the gold purchasing power has diminished greatly over time. It's not constant. The chart on the left shows you the gold price in real and nominal terms since the gold price was freed to float in 1968, March 1968. And you can see, the dark blue line is the real inflation adjusted price, and it varies in this index from about 100 to 800. And this chart only goes through the fourth quarter of last year. If you saw this now, you'd see that the gold price is probably past that 800 on a real basis, and it's definitely past the 1680 or 1640. That was the annual gold price average in 2012. So the gold price in the modern era of free fluctuating gold prices has fluctuated sharply. Now, there'll be people who tell you that, oh, well, you could buy a Ford Mustang in 1967 with a given number of ounces of gold, and you could buy a similarly, you could buy a Ford Mustang in 1977 and 1987. And you can look at this chart and you can say, yeah, I can see that. The gold purchasing power in 1967 was similar to what it was in 1977, and again in 1987, and again in 2007, as it crossed that line. But in between, you could buy a tire for an ounce of gold, or you could buy a fleet of Mustangs for an ounce of gold. So the reality is that changed sharply, and there's a great deal of fluctuation. That average price is relatively meaningless. The gold price fluctuates sharply, and it's not a source of constant purchasing power. So why own gold? Well, it goes back to what I was saying earlier about interest. If you can earn interest on some asset, a currency, gold, silver, gold and silver actually do pay interest. A lot of people don't realize that when they say, oh, well, gold doesn't have a yield. Yeah, it does. It does have a yield. And we work with our clients to get yields all the time for them. Most people don't know to ask for it or demand it. But if you can earn interest on something, that interest-bearing aspect of that asset leads to the deterioration or depreciation of its purchasing power over time. So this chart looks at that gold price in pound sterling from 1700 forward, and it also looks at the pound sterling. And you can see the pound did a little bit well during the British Raj, but you can also see that the pound has fallen sharply, roughly in line with gold in terms of long-term purchasing power. And the next chart I'll show you is gold versus the dollar. And that only goes back to 1800 because the US wasn't around in 1700 as a country with currency. But you can see again the long-term deterioration. And that's the key to gold's purchasing power. Because you can earn interest on it, and because it's a commodity that has fluctuations in supply and demand, the gold price has tended to deteriorate over time in terms of its long-term purchasing power. That doesn't mean it's not a good store of value. Yeah, because your other stores of value are cash and various currencies and silver, and they all deteriorate over time too. Adam Smith in The Wealth of Nations said very importantly that your wealth is not defined by the amount of gold and silver and money that you have in your safe. It's defined by the investments you've made in productive capacity. The ability to invest in things that make more money. Because money and gold and silver as quasi-money deteriorate over time, putting all of your assets into money and gold and silver will lead to a deterioration of your purchasing power of your wealth over time. But if you invest in a gold mine that's making more gold, or making more gold and selling it and giving you the dollars that it earns from selling that gold, then you have the ability to compensate for that long-term depreciation in your wealth that you have in currencies, gold and silver. So it's important there. And that actually came up this week because somebody who has historically pointed out to investors that gold is a relatively sterile asset and it doesn't really return a yield in his view. And he would rather invest in productive assets, invested in a productive asset recently. He bought into a gold mining company as opposed to physical gold. CPM Group, again, if you're familiar with us, we advise our clients, our investor clients, to invest in gold and in gold mining companies, and a range of gold mining companies, and a range of ways to invest in gold: short-term, futures and options, long-term physical gold. little food for thought on the weekend. I hope you enjoyed it, and I look forward to talking to you next week. We have been doing some market commentaries on silver and silver's relationship to gold, and perhaps next week we'll have the ability to make the video about that. Thank you, and have a good weekend.